We discuss interest rates and monetary policy on this program quite often. Let's face it, it's towards the top of the list of hot topics in finance these days. What we haven't heard about in a while is the possibility of a recession, but should that be back on the table? And what might investors consider once we're potentially in a lower rate environment? We're going to chat about all of that right now on UBS Trending. Hi, everybody, and welcome to UBS Trending. I'm Anthony Pastore. Great to be with you today, and thank you for joining us. And in the studio with me today is Lauren Goodwin, economist and chief market strategist from our partners at New York Life Investments. Lauren, great to have you here.
Thank you for having me.
We're going to get to the R word in a second, which I haven't really uttered in this room in a while. And our audience, if anybody's been paying attention, will know that. But before we get to that, we're talking about, look, we're coming off of jobs numbers that we just got last week, where we saw a continued rise in payrolls, but unemployment also went up. So everybody's saying, oh, this is the sweet spot for the Fed. Obviously, we still have CPI to come. But now the expectation is generally, and here in CIO at UBS, is 2 more cuts this year, 25 basis points lower in September and another in December. But economists a year ago were calling for a recession. Then it died down. But you're kind of putting it back on the table a little bit. Talk about why.
When the Fed starts raising interest rates, the economy tends to evolve in a fairly similar fashion, regardless of the economic cycle. So they tend to rhyme. Mm-hmm. So you typically see the interest rate sensitive and liquidity sensitive sectors experience some stress, then manufacturing. Only after that do you see corporate profits and then the labor market begin to topple in almost like a line of economic dominoes. And in this economic cycle, the forces supporting those economic dominoes have been really strong. Mm-hmm. It's been things like, for example, yes, interest rates have moved higher, but a large proportion of mortgage holders in the US have fixed rate mortgages, so they're not feeling the stress of that interest rate rise. The reality, though, is that it's been 2 years now that interest rates have been moving higher, and we're starting to see, including with last week's jobs report, much clearer evidence that the economy is slowing. We're seeing weakness in the manufacturing sector. We're seeing the labor market begin to and continue to weaken. And inflation looks relatively well contained at this point, not at, but moving towards the Fed's 2% target. And so this last 9-12 months in the market, we believe has been a soft economic landing, but that aggregate force of the Fed's tighter monetary policy is the next step on the way to what's likely to be a mild recession.
Okay, it's interesting, because so let me see if I got this right. You're saying that we're already in the soft landing, not we're preparing to be in a soft landing.
Oh, exactly. I mean, if you
That's
look
an interesting perspective.
If you look at where financial conditions have been over the course of really since November of last year, when the Fed made its pivot saying we're probably done hiking interest rates from here.
And by the way, when Treasury rates on the 10-year, we were just coming off of all-time highs from the end of October.
Exactly.
So let's not forget where we were in the rate department there either.
And in that intervening time period, we've seen market financial conditions be incredibly well contained. An equity market that's continued to move higher. Spreads that have been moving tighter and tighter, yields that have had some volatility but are relatively contained. This has been the soft landing experience. But in reality, for investors, soft landing is usually a step on the path en route to a more protracted slowdown.
Yeah. But is it a hard landing at the end of this, or is it just continuing to glide lower?
We do expect that we'll see negative GDP growth or a recession. But when we look in the post-war history, the mildest recession was the 2000-2001 recession, which we believe is likely to be a reasonable analog. And in that type of environment, you're looking at an unemployment rate that went up by 1.7%. That would get us to about 5.1% in this cycle. So nothing that approximates disaster. We also are seeing a relatively, in fact, quite healthy corporate and consumer or household sector in terms of balance sheets, meaning that actually if we saw growth slow over the next 12 months, we'd be unlikely to have a financial crisis that accompanied that slowdown in growth.
Right. So I guess, the next logical question to you is going to be, we do expect the Fed's going to cut rates, which essentially means that rates are starting to come down on the consumer level as well. What happens in that scenario once we start to see rates really decline?
couple of things, and I think it's a really important question. The first is that we're likely to see money move in a couple of different ways. One, I think that we'll see money start to move from cash into fixed income. Let's say we get 25 or even 50 basis points of cuts at the end of this year. That's, in economic terms, not a huge difference.
Right.
But when it comes to changing investor expectations, that's a sign that the high yields that we've seen for the past many months are starting to move lower. It's time to lock in higher rates. So I think we'd see a big flow in not only households or retail investment flows, but likely in the private markets as well. Real estate, private equity, these are fundraising environments that have been really locked up under the uncertainty of what the credit cycle might look like.
Right, of course.
And that would be an important signal.
Yeah, I was just having a conversation earlier about the muni bond market, and you look at that yield curve and it's very steep. Meanwhile, you look at where treasuries are and we're still inverted. So people aren't really going out long, at the long end of the curve because it's so much better at the 2 and the 6 month and the 3 year. So it seems like there's so much more opportunity. So like you're saying, locking in now for something that's a little bit more extended down the line seems to make sense for investors who are looking to get those higher rates when rates are declining.
I think it's such an important question. We did the math on this recently because I myself had the question of what is the perfect time to lock in higher rates? Is it right after the Fed moves, right before? And what we found is that both in terms of the pivot that we saw at the end of last year and the pivot towards actually cutting rates that we expect to see at the end of this year, the closest to perfect time is 2 to 3 months before the Fed actually makes that move. And the reason is in that 2 to 3 intervening months, the market catches on and starts to see confirmation of data, conditions that suggest the Fed will cut. And so if you expected a first cut in September, for example, it would be reasonable to start inching into short duration fixed income and lock in higher rates. But I love what you said about the municipal curve because despite this moving in locking rates, fixed income perspective that we happen to have, interest rate risk, given not just what's happening with the Fed, but really what's happening in long-term inflation expectations, the long end of the curve, it's not our favorite place to take risk in terms of portfolio construction. So we actually like that pair, short duration fixed income with long duration municipals where the curve is steeper.
Yeah, and you're getting the tax benefits there as well. So that's always a good thing to be thinking about. Obviously, people talk to their financial advisor to make sure it's appropriate for you. But as we're sort of going in now, we're fully into the second half of the year. It's hard to believe we're past the halfway mark. I can hardly believe it myself. But there's an election coming. There's possibly 2 Fed rate cuts coming. What should investors, besides locking in those rates as we talked about, what are other considerations are at play right now?
I think we've just had 2 years of uncertainty after unprecedented after uncertainty. Portfolio construction is as important as ever. We talked a little bit about duration, locking in rates, but considering overall interest rate exposure. I think that also considering the structural trends, I don't want to say tried and true because there's no such thing, but the areas of investment that we're seeing in the economy, regardless of who wins the election, as an example, we think are other interesting opportunities. Infrastructure is one of those. Artificial intelligence, which actually in a way is also a play on infrastructure in this stage of AI where we are. These are the types of things that we're considering. And so balancing, for example, a U.S. equity exposure with some small and mid-growth companies, some international companies, and as frankly, boring as it might sound, balance makes sense when we don't know exactly which way the puck will go. And that's the way that we're treating portfolio construction right now.
Absolutely. Thank you for saying that because I think it's really important to understand that there is a balance for each individual investor. And like we said, every investor has their own time horizons and risk tolerance. So make sure you're talking to your financial advisor. Anyway, Lauren, thank you so much. Interesting perspective. Glad you were able to come and talk about that with us today. I would imagine that we'll probably hear more and more about the dreaded R word over time, but we'll have to see how that goes. But good to have you join us today.
Thanks for having me.
Great. Thank you. Lauren Goodwin from New York Life Investments. For more information on anything coming out of our great partners like New York Life, and of course our own Chief Investment Office here at UBS, you can visit our website at ubs.com/views. Plus, you can follow UBS on all the major social media channels. You can also give us a follow on Instagram at UBS Trending. Click that and you'll find some great content there. And I've said it, I think 3 times already. Make sure you're continuing this conversation with your financial advisor. And until next time, I'm Anthony Pastore. Have a great rest of your day. And remember to keep your eyes on what's trending. We'll see you soon, everybody.